Today, we're going to continue our series by talking about the purpose of the three financial statements and understanding what profit is. So, as an accountant, you're responsible for preparing three primary types of financial statements representing a business. The income statement reports your profit making activities, your revenue, your expenses, and reports out the bottom line profit or losses generated by your company over a specified period of time. The balance sheet is a snapshot of the company's financial position at a point in time and includes all your accounts receivable, cash, so your assets, your liabilities, what you owe, and how much is in shareholder equity or owner's equity, which is how much is left over for you. The cash flow statement, which is one that I think is really important and a lot of people don't pay enough attention to, tells you how much money was generated by profit making activities, what happened with the money, and whether or not there's any changes in asset or inventory levels. The combination of the income statement, the balance sheet, and the statement of cash flows gives you an overall picture of the health of your business and how you're financing your business and where the cash is actually going out to. So I'm going to focus in this discussion on reporting on profit, because that's really one of the critical components of why we're in business. We're there to make a profit. Now again, profit and cash are two different things, and that's why the cash flow statement is important. I'm going to talk on a little bit of that, or touch on it here at the end, but one of the most important aspects of running any company is profit. Our economy is based on what businesses do to derive profit. That profit then is spent by entrepreneurs to either expand their business or to buy goods or services or to invest in other businesses. It sounds like a simple concept. Make more money than you spend, and then you end up with profit. But as always, nothing is quite as simple as it seems. And so there's a lot of intricacies in an income statement that you really need to be aware of. The net income first identifies, or the net income statement is going to identify the business that's being summarized. And you're going to see that at the top. And then the date range for which the financial statement is covering. So as I just mentioned, income statements cover a range of dates, not so it's from December to January of 2021, or from January 1 through March 31st, first quarter of 2021, or the week of September 9th. And so it's over a period of time. And so the income statement will first tell you the company and then what period of time it's actually measuring over. And then it starts off at the top with your revenue. How much money was actually brought in by all your business activities during that time? And that's going to be, your revenue from operations, your interest income, your rental income. All those things should be itemized out separately, but reported at the top as gross revenue or total revenue. Then the next section of the income statement is normally going to take out your direct expenses. So, if you're, let's call it a FBA business, you've got your gross revenues coming from selling whatever you sell on Amazon minus the cost of those particular items. So your cost of goods sold or your cost of direct services, that's going to leave you with gross profit, which is a contribution margin to your overhead. Below that are your overhead expenses. So your internet, your telephone expenses, your cell phone expenses, your office expenses, your transportation expenses, all those things will come below the gross profit line. So you start off with revenue minus your costs of direct expenses, which again, if you're in a services business like an accounting firm, that's going to be your cost of actually providing those services to your clients, so the salaries for the accountants providing services. Then you've got your overhead expenses, which are going to be rent and support salaries and other things. And then you get to the bottom where you're going to have depreciation, amortization, and some of the intangible non-cash expenses kind of come toward the bottom. And at the end, you're going to end up with your net profit. And so the way to read an income statement is from the top line all the way down, every step of the way, and understand each section and make sure that you have a good feel for what should be in there so that you don't miss anything important. As you go through every expense on your journey through the income statement, remember that there should be, if you're spending more money, it should be driving something, return on investment. So it should either be driving additional top line, additional bottom line, or additional money in your pocket. And assets and liabilities, if there's been any changes there, that's not normally reflected on the income statement. Where that's going to be reflected is over on the cash flow statement, where you can see money that comes into the business and is invested in additional assets, or is sent to pay down loans, or money that comes in from loans. That doesn't appear on your income statement at all. That appears on the cash flow statement. And so you're going to want to make sure that you have the two of them side by side to see how the cash is actually flowing through your business. The information that you're going to find on the income statement is really your day-to-day operations. It's your cash coming in from your day-to-day operations and your cash expenses going out from your day-to-day operations. When thinking about profit, two areas to focus on are, changes in cash from operating activities on the cash flow statement and net income on the income statement. Those two numbers are going to show you how much cash your business is generating, and cash is your business's lifeblood. Without cash, you're going to be out of business. The second factor is in the cost of financing and fixed assets, kind of a longer term view of your business. Differences are usually attributed to financing fixed assets and other investments. Changes in liabilities and assets that don't immediately flow through the profit and loss statement are going to be sitting over on your cash flow statement. So the way I tend to look at financial statements is I look at the income statement and see what the net income is. Then I go over to the cash flow statement and I look at the top section of the cash flow statement, which is cash from operations, and I look to see if there's a difference between my net income and my cash from operations. And if there is, I try and understand, okay, what's going on here? Why is my operations generating more or less cash than my income statement would indicate? Because the income statement would, well, it's got amortization and depreciation, which are non-cash expenses. That's also normally kind of a trigger that you need to be investing some of that cash back into additional property, plant, equipment, or additional inventory, or additional assets, or kind of prepping for or utilizing it for acquisitions. So the two should be close, and if they're not, then you're going to your financing activities and investing activities, which are the next two sections of the cash flow statement, and it's going to tell you kind of what's flowing in and out on your balance sheet from a debt perspective and from an equity perspective, in order to be able to kind of see where your cash is going, and then how many assets, like fixed assets, are you buying, or what types of investments are you making that aren't appearing on your income statement right away, but will probably be generating, or hopefully will be generating, profit down the road and flowing through the income statement later. I look at those two things side by side, and that gives me the best picture of what's happening from a, is my business really profitable perspective, because an accountant will tell you you can be profitable on paper but have zero cash in the bank, and vice versa. You can have a business that on paper looks terrible, is losing $500,000 a month, but in the bank they're making $200,000 a month because there's a lot of depreciation or a lot of amortization from an acquisition several years ago that's still flowing through the income statement, but is not impacting current cash operations. So you got to look at the two kind of side by side and understand those differences. Quick thought on net worth and cash flow. Net worth is also referred to as owner's equity in the business. They're not exactly interchangeable, and net worth on your balance sheet isn't necessarily what your business is worth if you were to sell it. It's kind of a general idea of the total assets minus the total liabilities. That's the mathematical calculation. So you've got your total assets, cash, inventories, accounts receivable, all the way through your building, etc. Minus liabilities, what you owe to folks. One minus the other gives you the net worth, and it's kind of a forced balance calculation. Having said that, it doesn't necessarily mean that if you sold your business, you're going to get that amount for your net worth. You may get more, and in some cases, you may get less, depending on how much in the way of intangibles and other things. And intangibles are things like goodwill or patents or some of those types of assets. How much of those are baked into the actual value of the owner's equity or net worth? Those are going to tend to be higher or lower than what's actually in there, and can cause your books to fluctuate a little bit. Shifts in assets and liabilities are important to owners and executives of a business as well, because it's your responsibility to manage and control those changes. Those include managing cash flow, but also the management of other company resources like inventory and fixed assets that may be liquidated in the event that you need additional cash. And some businesses run very lean on inventory, and the reason they do that is you need less cash to do that. On the other side, when you run into a supply chain crunch like we're seeing in automotive right now, where there's a shortage of chips, if you ran really lean, you don't have much inventory, you may end up having to shut your entire line down. So again, there's running a business there's a lot of moving parts, and accounting statements can provide you with the information you need in order to be able to understand what's going on in your business, and then make intelligent decisions on how best to react to and plan for contingencies going forward. I hope these videos are useful to you. I'm going to be continuing this series every other day. If you are enjoying them, please like and subscribe, and you won't miss any of the videos that are going to give you a little bit more insight into accounting from a entrepreneur's point of view as you drive to FI. Until next time.